Hello and welcome. I'm Alex Proimos, Head of Institutional Content and Investment Magazine, and this is Market Narratives. This show is a series of unorthodox conversations with thought leaders influencing the world of fiduciary investors. For more related insights and analysis, please remember to check out our website, investmentmagazine.com.au, and subscribe for a free email. And with that, please enjoy this week's episode. Hello and welcome, everyone. Today I'm joined by Sean Henaghan, who's the AMP's former Chief Investment Officer of the Multi-Asset Group, who's now still on his 15-month sabbatical. Let's hear from Sean. How are you today?
Yeah, very good. Thanks, Alex. So I'm sitting here in Whistler in British Columbia, Canada, just getting ready actually to recontinue our travels. The national parks are now opening up around British Columbia, so my wife and I are going to pack our mountain bikes, a tent, and hit the road and head up to Banff and Calgary and start to explore the Rockies.
So how far are you along on this journey? I know it sort of was a 15-month journey that you wanted to.
Yeah, so we left. We flew into Santiago April last year, and then started in Patagonia. And spent 9 months travelling up, backpacking through South America and Central America, and then arrived here in Whistler in December, middle of December, to spend the ski season here. I got joined by my family, my children, for a couple of weeks in early January. And then, of course, the virus hit and everything got shut down March 11 here. So we basically been quarantined in Whistler, which is not a bad place to be quarantined. I mean, the outdoor activities around here are just unbelievable. The trails and the mountain bike riding and stuff. So it's not too bad, but it is. We are getting a bit of Groundhog Day, and I'm actually a bit jealous of people working because it just gives you something to help fill the day. I say that now, but probably if I was on the other side, people looking at what I'm doing and thinking, "You're crazy." I'd much rather be doing what you're doing. So it's. I guess it's a bit. The grass is always greener on the other side.
Oh, look, there's always an irony when you're working, you just can't wait to stop and have a break and try to relax. And then when you're away, you start to get itchy, especially during these sort of market environments where a lot of things are happening. Do you feel
Absolutely.
that itch to get back into it?
Yeah, absolutely. Look, and I sort of, I don't know if there's any way I can help, but I just think, I speak to some of my former colleagues, or my colleagues still at AMP Capital. With everyone working from home, it's made a bit more of a challenge. I thought maybe I could dial into the odd meeting but I think with how people are working at the moment, it's not that practical. But I do, I feel, like the GFC is still relatively fresh in my mind, and just coping with all the challenges that created, and just, looking at the situation now, and, it's the crises are actually sometimes perversely the most interesting times you have in your career. And so, as much as I'm empathetic for what my colleagues are going through, I'm also a little bit jealous.
Do you feel that, being away from Australia also gives you a bit of a clearer head in sort of seeing what's happening?
Yeah, look, I sort of, yes and no. I was quite disciplined when I was backpacking through South America, just to completely switch off. Mm-hmm. So I had a good 7-8 months just not even thinking about work, and that was part of the reason I did this trip, was just to step away and clear the head, and focus some time with my wife, and just get back to doing something that we both really, really loved doing, and that's that sort of backpacking, traveling, and that that in itself is quite hard work as well. It's interesting, when you're backpacking, you're only planning out 3 days in advance, so you're always thinking what you're doing next, and it's sort of, you're quite busy. It's once I've arrived here in Whistler and we're not moving around, I've got a lot more time, and that's when I'm starting to, to get a little bit sort of itchy, and starting to think more about what's happening back in Australia, and reading the Fin Review as an example, and reading sort of some more of the media or the local industry papers, etc. And so I have been drawn back into it, particularly now with what's going on around the liquidity issues, or illiquidity issues, and just example with the fraud, taking money out of soup, and the challenges that's created for people. But look, I still think, bottom line, I think Australia, having the system that we do is a huge advantage. Once again, the Australian equity market, I think, has, in terms of the capital raising, has been one of the most active in the world. And when you have this very deep pool of domestic capital, it makes it far easier. So, again, it's probably going to give Australia sort of a huge advantage when it comes to managing this crisis.
But from when you're sitting away, 10,000 miles away from Australia, do you sort of get a little bit disheartened? Like you can talk about where the Australian super industry is, but do you feel a little bit disheartened because you're sort of outside the noise of the bubble of AFR and local media and what's happening in the local superannuation industry, but sort of more broadly in terms of what superannuation has achieved to date? Are you feeling is there a clearer light to you, I guess, in terms of how you review what's happened to date?
Look, yeah, I think it's I think this obsession with peer rankings, chasing performance, is a real Achilles heel in our industry, and it just creates the wrong focus and it creates bad outcomes. I think I've been quite horrified at the treatment of Sam Cecilia by some elements of the media. He in operating Host Plus like he did, and we had some meetings to talk about stuff, and Sam was quite comfortable with the strategy that he'd undertaken. There was critics of it in terms of classifying some assets as defensive assets, but given the profile of his membership, I don't think he was behaving necessarily in a way that deserves the reaction that he's had to date. I just think it's But I think that the industry is sort of not forces that, but really encourages that behaviour, because if you're the best performing fund, you're lauded by the industry, and it's all about being the better performing fund. So invariably, people are going to be taking too much risk, and I think now is a classic situation where I'm really concerned about valuations in the market. And so, if you were an investor that was purely focusing on what was delivering what members wanted, at the moment you'd be really focusing on capital preservation. But the problem with that is you run a real risk of, if markets do continue to rally, you start to drop down the performance tables, and that creates all sorts of pressure. So I just think, the industry needs to focus on what the objective is, and that's providing a predictable, steady income in retirement. It's not about maximising capital value. This whole focus on accumulation rather than retirement made sense when the industry was still in its infancy, but now we're starting to get pretty mature, and I think there's no net growth in the accumulation phase across the industry. It's all in the retirement phase, and I don't think the industry has quite got where it needs to get in terms of providing that retirement income.
You raise a lot of issues there. Maybe let's go back to sort of Host Plus and some of the issues that were sort of raised in terms of how growth focused their portfolio was, and there was concerns about particular assets being classified as defensive, but were really growth and so forth, and sort of on the fence on a number of decisions there. I guess one of the biggest challenges for these funds, early access aside, is how do you manage to this cohort? And so for Sam's benefit, he had a median age that was quite low. It was allowed him the flexibility to think long term. Now, I guess my question to you is, if you're trying to manage that portfolio, yes, you can look at it from a 30-year horizon and say, I've got the time. Aside from the government interference, he's got a 30-year horizon. But does that mean that he should still be fully invested in growth style assets? If you talk about getting to, this retirement stability of income, I guess one of the questions that keeps coming up to my mind is, do they need to sort of take risk off the table and actually sort of realize where market valuations are? There's been a lot of research about the current valuations in market and what does that mean for future returns. And so are we putting a lot of superannuation monies at risk because we sort of just think very, very long term, but are sort of missing the underlying problems in markets in terms of valuations and so forth? How do you balance that out, aside from even the peer risk issue?
Yeah, look, I think there's too much. If you're a person looking forward to retirement, I think there's too much focus on trying to achieve an outcome based on investment performance. Now, the other lever that you have, of course, is your contribution rate. And I think, if you're running a fund and you're saying to members, okay, I'm going to try to deliver you inflation plus 3 over the long term, which is not a very aggressive return outcome, but probably today, if it's where we're starting today, anyone would take that outcome. But just to say, inflation plus 3, if you want to retire on, X percent of your salary, you have to save 13, 14, 15, 16% of your income. So, it's like driving from Melbourne to Sydney. The analogy I use is, it's going to take you on average 10 hours, but so you leave at 8 o'clock in the morning. You don't leave at 10 o'clock in the morning and, rent a 4-litre car and try to get there in a hurry, because sure, that might work, but you'll be speeding. The chances are that you could, you could get fined for going too fast, or you could actually cause some damage. So I think the analogy is, I think that there's too much about this trying to generate really high returns, rather than saying, okay, let's just get a return which is achievable and we're comfortable. Focus on that, and then put some more onus on contribution rates. Now, I know that's a lot of people can't afford to put 15% of their salary into long-term retirement. But my point being is, I just think this obsession about trying to chase performance results in undesirable outcomes. And I think you can look at the way people behave, but if that's how they're rewarded, so I think people like, if I was someone like Host Plus or whatever, I just wouldn't participate in the surveys. And I'd have a system about communicating. It's all about effective communication. I think, again, I've always had this view. I think communicating is as important as investment performance, particularly if you move to a more goal-based rather than peer relative or benchmark relative investment strategy. Mm-hmm. Does that make sense?
Yeah, no, it does. It does. And I think that is part of the problem, where you've got this situation where the communications that are out there at the moment is all coming from the media. So the media is pushing with the tables, the super rating tables and so forth. That's all driving this awareness to performance, and performance being the only outcome. So the danger with that is that people then become anchored by those performance numbers, and actually the funds take advantage of it, because they see it as a way to generate more funds under management, and they start putting on the side of a bus or on the roadway about how they're number one fund for 1, 3 or 5 or 10 years. So it's driving this just constant focus on a percentage number of returns, despite us, having an advertising at the bottom that says, there's past performance is no guarantee for future performance. But the reality is, people look at the numbers and they want to join these organizations, despite potentially, getting themselves into a lot of trouble, because these funds take on too much risk for their situation or where they're at in life, in terms of their age. So
it's interesting, isn't it, though? If we talk about, people talk about this mythical barbecue conversation where people compare their investment performance to their funds. Look, no one's ever come up to me at a barbecue and asked about the performance of my superannuation fund. I don't think that happens. I think you're bang on. I think it's the media, and I think it's our own obsession within the industry. I think outside the industry, people aren't as active as we believe they are. So I think we've created this problem for ourselves, to be honest. If you could think of a fund as a defined benefit rather than defined contribution, defined benefit funds did not compare performance with each other. There were no peer tables of defined benefit funds. It was all about delivering on the promise to the member. And I think, Paul Costello, when he looked at the MySuper legislation, he wanted more of a focus on that issue, about the trustees making a philosophy or belief to the members and then delivering on that belief or that outcome, rather than having this focus about doing better than everyone else. And it's just, it really does create more problems than it solves.
And I think the other issue is, we always talk about member engagement. And so the part about member engagement is often around these particular times. And so when things are going well, no one really checks on their superannuation. But as soon as they start to hear market volatility, they start to check their balance and say, oh, it's gone down X% and so forth. And so that's where this, I think, mindset for a lot of the actual members get really confused, where they say, oh, hold on, is my fund actually doing what it should be doing? And so how I guess the real challenge then is the communication part that you talk to in actually explaining to members, 5-6% steady return over 30 years is actually going to deliver you a very, very good outcome. As opposed to the sort of 1 year it's 15% up and next year it's down 8 and then it's back up 3 and it's back down 10. It's the frequency of this, just continual wins rather than these one large win and then a one, big loss. Just the geometric returns that come from these portfolios is better for just having this continual growth at a slower rate.
Yep. Yeah. Look, and it's been, I think having a highly effective communication capability is really, really important. When AMP Capital was looking at moving to goals-based across a range of funds, goal-based investing, where you target an inflation plus outcome, I did a road trip, went and visited half a dozen goal-based managers, predominantly in the UK, where that type of managing money had been, they were early pioneers in doing it. I did a couple in the States as well. And to an organisation, they all stressed the importance of communication. And in many cases, it was storytelling. It was, we bought this infrastructure asset because we expect to deliver an inflation plus 3 outcome over the very long term, with this consistent with what we're trying to do for the fund, and it consists of like a toll road in the US or whatever. So it was storytelling around the portfolio without necessarily just focus on the performance outcome. And they felt that was a better way to build engagement with the member. And it was pitched at a very basic level that actually made it easy to understand. And this importance of communication was a real lesson that I came back with. And I don't think that we're where we needed to be. I think there's a few organisations that do it very, very well, and we certainly weren't one of them. But it was something that we acknowledged that we need to get far better at. And I'd say that if you were building a capability in your organisation, to have a highly effective communication capability would be absolutely key.
Does that also help? I guess in terms of communication, there has been a bit of discussion around the role of super in supporting Australia, and as being part of a nation building piece. Is that something that you would consider as being beneficial to the superannuation industry, to keep people staying the course and being more engaged about where their money is going? And you mentioned a toll road. Is this one way
absolutely
funds could do it?
Absolutely. Yeah. I mean, it's. And I think there is a. I think there is a benefit and a perceived benefit of that. If you feel that your superannuation is going to creating a country that your children and grandchildren, I think there is a lot of positives around that. But the storytelling is that in terms of saying that we own this. When you're travelling on a toll road, it's like our superannuation fund invests in this, and even moving further beyond that and looking at some of the environmental issues, and how your superannuation fund can be a force for good in terms of tackling some issues like climate change and environmental issues. I think there again is something that can be very engaging and positive for the members. But what's really interesting is that we AMP Capital has an ethical range, multi-asset diversified fund. And when asked, most members would request an ethical option on the choice platform. But invariably, we only got flows into that fund when performance was good. Relative performance was good. So it's quite interesting. I mean, we say this, in terms of the storytelling and the beliefs and stuff, but it's quite interesting. Flows are still dictated by performance, which is sort of goes against what I've been saying in some ways. But I still think that the best way for a trustee to consider is to have a belief and a set of objectives, communicate those to members, and measure yourself against how you deliver against those, and just try not to have a focus on comparing to how everyone else is doing, because that's a distraction. It's when I was a consultant, I used to engage with trustees, and we talk about what the objectives of the fund were, and invariably they'd have an inflation plus objective, and you do your strategic asset allocation, your risk budgeting around that. But then they'd have a secondary objective of outperforming the peer group. And as much as we try to fight against it, they were insistent to have both, because they said it as a you will not have a business. Their belief was you would not have a business if you weren't generating above median performance. And I'm not sure that's the case.
Is there also a potential issue because of the allowance of members to move their funds quite quickly? We've got public offer now. Is that maybe part of the problem in terms of the funds being now more hyper aware about their performance and peer awareness, because it is so easy to move money from one fund to the next?
Yeah, look, it's interesting. The stats around people moving is not that great. I mean, when you get a Royal Commission or an event like that, absolutely that has an impact. But on the day-to-day, normal market environment, if you move from second quartile to third quartile, even fourth quartile over a 12-month period, there's very little, the stats that I've seen, correlation between that and member movement. However, there still is a daily unit priced industry where members theoretically can move their money at a drop of a hat or move it out of that option and put it into a more defensive option. So liquidity management is important, and this is what I discussed with Sam Cecilia about the defining a defensive asset, having a liquid asset as defensive. I just don't think illiquidity. I think to be defined as defensive, you have to have liquidity. You have to have daily liquidity. Otherwise, I don't think you can categorise it as defensive, because if you had a grade office building with the Aussie government having a 20-year lease, in many ways that is a very defensive asset. But what it doesn't have is liquidity. And I think with the industry being members can move in and out when they want, you have to have a decent level of liquidity to manage that. So I think that's just part of your investment constraints, is providing that liquidity. And I'm not, it's unfortunate that, because I think that does stop funds investing in assets. Like the industry funds, given their member cohort, they have better liquidity provisions. They can take more illiquidity risk than many of the retail funds. But that does means that you're suboptimal in terms of being able to invest in many of these assets that we would like to invest in. Because I personally think that infrastructure is a perfect superannuation asset. It's in most cases it's long dated. It has and traditional infrastructure has a inflation-linked revenue stream. So it's perfect. It's a matched asset for what funds are looking for. But also importantly, the world needs to invest in infrastructure. I mean, the numbers are staggering in terms of, I don't know if you've got a taxi to a New York airport and you drive along those motorways. It's just unbelievable how run down they are. So, US alone, it's trillions they've got to spend in infrastructure. So there seems to be, there's a huge demand. There's a huge supply need. So you'd think that, I think most funds, if they could have 20 to 30% of their portfolio in infrastructure assets, that's a win-win. The problem that you have, though, is the illiquidity and the bottleneck of matching demand with supply. So I got off the topic there a little bit.
No, but that ties back to, I think, some of the retirement challenge. You talked about sort of the no net growth in the accumulation space, which is sort of what's happening. A lot of these larger balances are rolling over to the retirement part of the conversation. And if the focus is, generating income in retirement, these are the assets that actually do that. So, you need to keep looking at what is the cash flow that's going to be spinning off from the assets that you hold.
Yep.
And particularly in a world where fixed interest is not really struggling to provide the returns that you need unless you start taking more and more risk in credit, for example. Here's an option where you can get a 5% maybe dividend from infrastructure style assets that can then help to address that retirement income need.
Look, absolutely, and I think that's a huge challenge you have today, right? I mean, if you're a retiree, wanting to live off the income from your capital, it's like, goodness, that's suddenly got a whole lot more difficult because of the dividends are not what they were. Your fixed income portfolio is generating very little compared to what was in the past. So you need to find sort of ideally lower risk income assets that can provide you a reliable revenue stream. And it's just creating the opportunity there to match that demand with the assets. And I think for a lot of funds, that's a huge opportunity because, creating a portfolio that generates a stable income has a whole combination of growth and income assets in it. And I think at times if income assets are way too expensive, you can, because you're not a taxpayer, you can be selling capital to pay a revenue stream, but it's got to be managed in a portfolio. And to do that as an individual is pretty difficult. But a superannuation fund that has got scale and has got access to, these very large infrastructure assets and direct property and other sorts of assets that you can't access at a retail perspective does provide an advantage. And so I think superannuation funds can play a very large role here. And, I think for SMSF funds to do it, it's going to be a real challenge. And so I think, historically how they've worked, it's been relatively easy for SMSFs to actually generate the income. I think that's going to be a lot more difficult going forward. And I think it's going to work in the favour of the funds that have the scale and the expertise to manage these sometimes quite complex assets.
Yeah, it's interesting you say that because there's these large assets that you need to purchase. It starts to then come back to the whole dilemma in the Australian market with the number of funds that are out there and this push for mergers. So the large funds, the Australian supers of the world and the CBUS and so forth, they're all keen to start buying these assets directly because it makes sense for their member base and so forth. But then the smaller funds are saying, well, hold on, we're creating portfolios that are much more targeted to our member cohort, and we're delivering better innovation and so forth. But if I listen to what you've just said there, it's like, well, unfortunately, some of these funds have to get much larger if they're going to be able to provide this income in retirement, which is the key piece that people are looking for.
Yeah, I think you that's probably right in a general sense. I mean, there's always unique. There are sort of specific opportunities that may be a bit different to that, but I think scale certainly is an advantage. It just enables you to access a much larger and deeper pool of opportunities. Plus, you have a level of expertise that is hard to match in a smaller fund. The smaller funds tend to have a more outsourced model. And I think that's always a bit of a challenge. But we've got to be careful here. I mean, these are general, broad sweeping statements. I mean, there's always exceptions to prove the rule. But I think the other big one, of course, with the retirement is the annuity. And that's I just you talk some of these bigger funds, they're getting of the size now where they're becoming quite substantial financial organisations and talk about capital and and what's going to happen there. But I think annuities are just, given what's happening with mortality and where interest rates are, they're just so expensive. I mean, a lifetime annuity is pretty impractical, or unless you are really, really risk adverse. I think, but you can build what we thought about at AP Capital was just breaking your retirement into components. You've got your essentials bucket, and you've got to have very low risk certain income to support that. Then you have your lifestyle bucket, which is the sort of the nice to have. But if you can't, if the portfolio hasn't generated the returns that you need to do that, well, then you just defer it for a year. And then there's the sort of the endowment, which is a long term, your inheritance and other things. And so if you start to break it down into that, you can start to manage it specifically, and you have a portfolio that generates the income or the capital growth from each of those different components. So rather than having a single portfolio try and meet all three needs, you have this segmented approach that enables you to be more focused and to build a holistic portfolio that's going to sort of support those needs. And I think the bigger funds have they have the better economies of scale to actually to do that. So I think, going back to beliefs, I think it's, I think a lot of the funds out there, we lose. Their biggest risk is not losing members to other funds. We're losing them to SMSF, and certainly if you have a substantial balance. But I think where the markets are today, I think I see that force diminishing, and I could be completely wrong. I'm not that close. There's probably a lot of people in Australia that have a far clearer understanding of that of me, but just from not seeing the woods for the trees sitting here in Worcester, although there's a lot of trees around here. I just that's my gut feel for how this is playing out.
I think that's a great transition to sort of the broader market environment, because yes, we talk about 30-year time horizon for the average member, but there is a lot of other members that are at retirement or within 10 years of retirement. And if this does end up being a very deep recession or depression, there's going to be huge downward pressure on asset prices. We seem to be really setting up the current market environment for another awakening. I think we're back up at January 1 prices for S&P 500. And so there's a lot of confusion from the asset owners that I've been speaking to in the last couple of weeks as we prepare for our upcoming Fiduciary Invest Symposium. And so what I'm worried about is that we keep telling people stay the course, and a number of the asset owners as well are advising members, this is a long-term investment and so forth. But if we end up being down another 30 or 40% because we go through a really deep recession or depression style environment, I'm concerned that people are being set up for failure, and then trust in the system starts to fall apart.
Completely. And look, and I absolutely agree with you. I'm looking at asset prices now and just thinking, this is crazy. I just think it's at that point where the more the worse the news, the more the markets like it, because they think there's going to be monetary and fiscal support. But it's just, my sort of instinct is to go very, very defensive. But the problem that you have, Alex, is that funds can't. If you're a balanced fund, you have to have between 60 and 80% of growth assets. And that's the system that we've created. And we think that's somehow a way of managing risk. But that's not. It's actually making the system more risky, because, in my career, there's been 3 times, 98, 2001, 2008, where, you felt you should be taking risk off the table, but you have this mandated that if you're going to balance fund, you have to have between 60 and 80%, otherwise you're breaching your PDS. And that just seems crazy. And I think so, but members are you talk to members and then they think we're being paid to actually, if we don't think we've been rewarded for risk, don't take risk. And they can't understand why they suddenly get a minus 20% return in their superannuation fund. So I think there is, but I agree completely with you. I just think there is a bit of a disconnect at the moment where prices are and what the economic environment is. It's just, it doesn't, I can't understand it. And I just worry that it's getting it way, way ahead of itself. And so for someone that's trying to generate an inflation plus 3 and inflation plus 4, that's just where we're starting today. That's incredibly difficult. It's incredibly difficult. So I said about at the start how I was a bit jealous of, my colleagues that are sort of working hard at this. In some ways, that's a challenge that I'm glad I'm not having to face, because I think it's a very, very difficult one.
Oh, look, it's a weird time, and there are the continual gold bugs out there, and the people that complain about the total financial system failing and the need to add Bitcoin to your portfolio. I've never seen so many references to both those assets, if you want to call them, asset classes as such, of late. And people, I think, a lot smarter than me, sort of starting to really be quite worried about just the broader system, the whole financial system that we invest in.
Yeah, absolutely. I was actually, funny you should say that, because I was actually thinking about Bitcoin yesterday for the first time. 6 months ago, probably a year ago, when it had that big rally, we were talking about it, and I just said, there's no way I'd ever buy Bitcoin because I can't put a value on it. Is it worth 8,000 or 10,000, 12,000? It's only worth what someone else will pay. And that's just as a value-based investor. That for me is just a philosophical hurdle that I can't overcome. But I'm looking at it now, just thinking, with the amount of money printing going on, the printing press is running overtime virtually everywhere. That's got to be debasing currencies. And so, if the fiat system does collapse, it's like it makes gold and Bitcoin, etc., look quite interesting. But look, for me as well, it's I'm sort of I worry during the sort of post GFC with ultra low interest rates and the quantitative easing, and how the world seemed to be getting, as soon as there was any risk, the central banks would jump to stabilize things. And I think we need risk, and we need people to be punished for taking excessive risk. I know that's somewhat Darwinian, but I think that's how the system operates. And we didn't get to where we needed. Rates did not normalize post the GFC, so monetary policy was still really quite expansionary throughout that whole 10-year period. And now we've had another crisis, and monetary policy has almost run its course in many ways. And so appropriately, the fiscal pumps have been turned on. And that's all well and good if you're a country like Australia or New Zealand that has very manageable government debt. But a lot of the world, are in the sort of the 80s, 90s, or excess of 100 as debt as a percentage of GDP. And people almost become a bit sanguine about it and think, it's not really a problem. And we can manage with debt level that's high because interest rates are so low. But I think if you've emptied out the ammunition on the monetary policy, and now you're sort of emptying the bank on the fiscal policy, where do you go next? So we'll probably get through this crisis. I think with the amount of fiscal stimulus and stuff happening, I think in 2 or 3 years we'll be back on stable ground again, but with very little options left when the next crisis strikes, and it will strike again. So I might be getting ahead of myself worrying about the next crisis when we're in the heart of this one. But, for me, I just think, look, the Fed buying sub-investment grade corporate bonds, it's incredible. I can understand they're trying to stop the market dislocating, but it's just, for me, that's making me very, very nervous. I think there's something that's unprecedented, and I think there's going to be consequences for that. And I think we need to have more companies going bust. Look, yeah, I mean, that's a very, very difficult conversation because of the corona. The virus is not a economic impact. It's a one-off, and no one can really expect this and the massive impact it's had. But I think for many companies, the way I look at it, if companies are operating and they go out of business after 1 month of no revenue, I think the world has to reassess risk and just be far more prudent in how we manage for it, and I think that's hopefully going to be a lesson coming out of this, which is going to mean a much, much slower recovery, because if consumers are going to be saving and companies are going to be saving, building up, balances, there's going to be less investment, less consumption. So it's going to be a very, very slow recovery, which impacts negatively on returns.
Oh, look, I think that whole issue about moral hazard is a huge one, and it's even sort of been raised in the local media about the zombie companies being propped up by the JobKeeper scheme of late.
Yeah.
And the further interest rates go lower and lower, we keep propping up businesses that are really not an efficient allocation of capital.
Completely, and they undermine the more efficient, well-managed businesses, right? Because they're not, it's not getting rid of the weakest competitors.
Well, it's actually even worse in my thinking of late, where you've got the Federal Reserve supporting these large scale bond issuers that are sub investment grade, so they're getting help, but the people that actually employ the largest number or the largest percentage of people in the economy are a lot of these small businesses, and they get no help. They can't issue bonds and go to market and get their bonds supported by a central bank. It just doesn't exist.
Actually, one of the benefits of being here in Whistler is I'm watching the PBS American news, and just watching what's happening in America. I look back at Australia and New Zealand, my home, and just think what amazing countries, how they've cope with this crisis. It's been unity. I mean, there's been pockets of disquiet, but I look what's happening in America, and it is just horrifying. The country is tearing itself apart. It's just incredible, and it's just, I think there's a lot to be said for the societies that New Zealand and Australia have created, which is outside the scope of this conversation. But, that's what I miss most about being in Australia and New Zealand, just how people are together on this,
All right, Sean, I think that's probably a great place to leave it, and we're happy to continue the conversation. There's a lot more we can talk about, but for today, I think that's a perfect place to rest it. Thank you for joining us. All views expressed on this podcast are subject to change and do not necessarily reflect the views of Conexus Financial. This podcast is for educational purposes only and should not be relied upon as investment advice.